If the pressure to perform now, and only now, feels like it's crushing everything, you're not imagining it. Our entire economic landscape has been rewired for immediate results, and the cost of that shift is starting to come due. Look around. Families are one emergency away from financial collapse. Corporate strategy is dictated by the next quarterly call, and markets hang on every syllable from central banks. Entire ventures are built not to last, but to be flipped. And this whole fragile structure is glued together with debt that's designed to be passed on, not paid off. This isn't an accident. It's the outcome of a system that now actively punishes the long view. Take something as fundamental as jobs data. When it fails to materialize, the immediate panic isn't about the workers, it's about the central bank flying blind for a month. These monumental decisions, which shape our futures, are being made using chaotic, short-sighted signals. But in this twisted new reality, bad economic news for Main Street can be celebrated on Wall Street. Why? Because pain might force a rate cut, and cheaper money means the speculative game can continue for just a little bit longer. We're financing the present by bankrupting the future. This brings us to a perfect symptom of the disease: the buy now, pay later explosion. It's a financial lifeline for consumers squeezed by inflation, funded by companies that themselves are burning billions in investor cash. So, we have a stunning paradox. Households who can't afford today are being bankrolled by an industry that can't survive tomorrow. And if you think this is just a niche problem with trendy payment plans, look closer. This is the blueprint. The most alarming part? Along this entire chain of fragility, from the consumer to the startup to the investor, almost nobody is generating real, sustainable profit. Yet, almost everybody is getting rich. Founders cash out. Executives pocket bonuses based on short-term pops. The regular person gets the temporary relief of a financed grocery bill. If the whole edifice collapses tomorrow, the architects walk away set for life. The consequences land everywhere else. How did we get here? Our brains are wired for short-term rewards. That's human nature. The problem is, we've rebuilt our entire economic engine to exploit that flaw. Over the last 40 years, 3 quiet revolutions warped all the incentives. Let's start with the engine of capitalism itself, the stock market. For most of history, if you owned a share, you got a regular dividend or reward for holding. Today, that yield has evaporated. The primary way to make money now isn't to collect income from a healthy business. It's to sell your piece of it to someone else. This subtle shift changed everything. In the past, a company with excess cash had 2 good options: reinvest it to grow or pay shareholders a dividend. Then, a rule changed in 1982. It allowed a third option. A company could use its profits to buy its own shares off the market. On the surface, this buyback seems neutral. In practice, it's supercharged short-termism. Why? Because it directly inflates the stock price by reducing supply. Management's pay is tied to that price. So the incentive became crystal clear. Pump the stock now, don't build for a decade from now. We're not investing in companies anymore. We're trading tokens. This creates a surreal circus. A CEO will loudly claim their stock is undervalued to justify a massive buyback, then quietly sell a huge portion of their personal holdings at that supposedly low price. The goal is no longer a legacy of leadership, but a single, life-changing score. And who's often buying the shares they're selling? The company itself with its own cash. This self-cannibalizing loop now accounts for almost all net buying in the entire market. Real investment in R&D, wages, and innovation is being starved. The second revolution is in ownership time horizons. The average holding period for a stock has plummeted. Large funds need to show results now, so they trade, not invest. This turns every asset into a hot potato. Success isn't about building a profitable business. It's about flipping an asset that might be profitable one day. This is why bad news can become good news. Weak job numbers don't signal lower consumer demand anymore. They signal potential rate cuts, which are rocket fuel for asset prices. The real economy and the financial economy have completely decoupled. The final corrosive change is in executive compensation. When top pay was high but modest, a leader needed to steward a company for a decade to build true wealth. Now, pay packages are so enormous, linked so tightly to short-term stock performance, that 1 or 2 good quarters can set you up for life. The rational choice? Engineer a short-term pop, cash out, and leave. The long-term health of the company, its employees, or its customers is someone else's problem. It's easy to rage at the individuals, but that misses the point. If you or I were handed the same rulebook and incentives, we'd likely do the same. The real issue is that this isn't illegal. It's the system working exactly as designed. We've legally encoded a get yours and get out mentality. So, is this just the new, permanent way of the world? Or is there a breaking point? The truly frustrating thing is how simple the fix would be. Change the incentives. Align rewards with real, long-term value creation, not quarterly price manipulation. It wouldn't take a miracle, just the political will to rewrite that rulebook. But that requires a long-term vision from the very people who have benefited most from the short-term game. And as we've seen, that's the one thing our current system is designed to prevent. If this breakdown of how we think about time and value resonates with you, please hit the like button. Helps this channel, Wines of Thought, reach more people. And let me know in the comments, what's one long-term project or investment you believe is worth protecting from this short-term frenzy?